In this class today, we'll be starting with the next segment of this chapter, that will be analysis of a discount policy. Now, first thing what I want you all to do is write up this heading in your notebooks, that is within the chapter Receivables Management. Please write this subheading as analysis of discount policy. Analysis of discount policy. And once you write this heading, let me explain something very important with respect to analyzing a discount policy. And what I'll do is I'll show you something here on screen, and I'll help you to understand how to interpret that line, and then I will dictate a line which you must write down. So be careful about when you are writing something without viewing the same on the screen. I'll just utter it out and you will have to note it down. So first let us observe that particular line. This is supposed to be a very important line, and what exactly this is trying to convey, this is the style in which in real life the credit terms or the discount terms are mentioned. So it is 1 by 10 net 30. 1 by 10 net 30. How do you interpret this particular line? 1 by 10 net 30 means the credit period is 30 days. The credit period is 30 days. That means from now, the maximum time over which the customer has to pay is 30 days. However, if the customer is making the payment within 10 days, then we will offer 1% cash discount to the customer. So 1 by 10 net 30. How do you interpret this? That credit period is 30 days, and if the customer makes the payment within 10 days, the customer will be offered 1% cash discount. I want you people to write down this term, that is the credit term, and also write the interpretation of the same. First you write 1 by 10 net 30, exactly the way it is appearing on screen. 1 by 10 net 30, and then write up the meaning of this line right below this. This means that the credit period is 30 days. This means that the credit period is 30 days. Put a full stop and write, however, if the customer makes the payment, within 10 days, the customer will be eligible. For 1% cash discount. The customer will be eligible for 1% cash discount. So let me repeat this line. The term is 1 by 10 net 30, and the meaning of that, how will you write? This means that the credit period is 30 days, full stop. However, comma, if the customer makes the payment within 10 days, then the customer is eligible for 1% cash discount. I hope you have written exactly in the same manner as I have mentioned. Now let us do one thing. Let us have some more credit terms for us to interpret over here. So let us have another type of credit term over here, which is 2 by 10 net 45. I'm sure now you can on your own interpret this line. That will be credit period is 45 days. However, if the customer makes the payment within 10 days, the customer will be eligible for 2% cash discount. Let us have, for example, yet another credit term, that is 2 by 7 net 21. How would you interpret this line? 2 by 7 net 21. it means the credit period is 21 days. However, if the payment is made within 7 days, the customer will be eligible for 2% cash discount. The customer will be eligible for 2% cash discount. So I'm sure you have written this whole thing. And now let us do one thing. Let us move ahead and write up the solution for the next question. That will be question number 14. Let us first read this question. D Limited presently offers discount policy of 1/10 net 30. That means the company is already giving a discount policy to its customers as 1/10 net 30. Let us recollect how do you interpret this line. 1/10 net 30, it would mean the credit period is 30 days. However, if the payment is made within 10 days, the customer will be eligible for 1% cash discount. Further given, its annual credit sales at present is rupees 36 lakhs and 20% of debtors are currently taking the benefit of cash discount. Now, this line is very, very important in the question. Out of all your customers, 20% people are taking advantage of this policy. Means 20% customers are making payment within 10 days. So it is implied that remaining people will be making the payment in 30 days. The company has gross profit margin of 20% on sales. Cost of capital for the company is 15% per annum. The company is considering a proposal of changing the discount policy to 2/10 net 30. Now, how do you interpret this line 2/10 net 30? The credit period will be 30 days. However, if the payment is made within 10 days, the customer will be eligible for 2% cash discount. So, comparing with the current policy, the new proposed policy is just changing one factor, correct? Just changing one factor. What is that one factor? It is enhancing the discount rate from 1% to 2%. It is expected that because of this new policy, overall sales will increase by 20%. So, overall sales will increase by 20%, and now 80% of total customers will start availing the benefit of discount. 80% of customers will now avail the benefit of this discount. Advise whether the company should accept this proposal. So when you are attempting the solution of this particular question, what you really need to understand is that we are analyzing a discount policy. The current policy of the company is to provide credit of 30 days to its customers. The revised policy does not change. It is still providing credit period of 30 days only. However, as per the present policy, if the customer is making the payment within 10 days, we are giving 1% cash discount to that customer. Under the new policy, the condition remains same. That is, if the payment is made within 10 days, we will give discount, but now we will give 2% cash discount. Because of this attractive discount, where instead of 1% you are giving 2% discount, you know what will happen? You will find that the customers will be more attracted and they will have more purchases made from the company. In other words, the company will be able to sell more. Current sales are given as 36 lakhs and the revised sales will be 20% more than that. So 20% more than that means it will be 36 lakhs plus 20%. So 20% of 36 lakhs is what? 7,20,000. 7,20,000 added to 36 lakhs, it will become 43,20,000. So you can again have the analysis by making a comparative profitability statement. You can begin with sales marked as A and writing that as 36 lakhs in the present column and 43,20,000 in the proposed column. Then comes the next line, that will be cost of goods sold. Cost of goods sold will be 80% of your respective sales value. Why? Because they have given that gross profit margin is 20% of sales. That means cost of goods sold will be 80% of sales. So you can mark that cost of goods sold as B. Then there will be cost of funds blocked. Now, while computing cost of funds blocked, what you need to really consider is, presently out of all your sales, 20% people are paying within 10 days and getting the benefit of the discount. But under the new policy, it is expected that 80% people will be taking benefit of that discount. So what will happen, even though you are having more sales, but big possibility that your average balance of debtors will get reduced because of quick payment made by so many customers. And not only that, your cost of funds blocked may also get reduced. So cost of funds blocked will be yet another component. Definitely here there is no information about bad debts, but we have one new component coming up like cash discount. So you will have to carefully work out what will be the amount of cash discount under the present policy and under the proposed policy. So what all elements we are going to find in our comparative profitability statement? Number 1, sales. Number 2, cost of goods sold. Number 3, cost of funds blocked. And number 4, cash discounts. So you can mark these as A, B, C, D, and your net benefit will be A minus B minus C minus D. And depending upon how you are getting your calculations of net benefit, if your net benefit is increasing as per the proposed policy, then you implement the proposed policy. Otherwise, you may just continue with your current policy for future as well. So let us now see how to present the solution of this question. In your solution, you will obviously first begin with some working notes. Getting started with working note number 1, calculation of average balance of debtors under old policy. How will you compute the average balance of debtors under old policy? It will be 36 lakhs into 20%. That gives you 7,20,000. This 7,20,000 will be collected within 10 days. So the average balance is 20,000. I repeat, 36 lakhs is your total annual sales. Out of this, you are splitting this into 20% and 80%. 20% of your customers are paying within 10 days. So to such customers, the average balance of debtors will be 20,000. And what about the remaining 80%? 36 lakhs into 80% gives you 28,80,000. Basically, 7,20,000 plus 28,80,000. Aggregate of these two will match with 36 lakhs. So this portion of your customers are paying within 10 days and this portion of your customers are paying within 30 days. So your average balance of debtors will be aggregate of these two, which is 2,60,000 under the old policy. Let us move ahead and have a similar working note, that will be calculation of average balance of debtors under new policy. So under new policy, first of all, the sales will be 43,20,000, and now you split that 43,20,000 into 80% and 20%. First of all, 80% of your customers will pay within 10 days, for which the average balance of debtors is 96,000, and 20% of your customers will take 30 days of time to pay you, and that will be 72,000 as your average debtors balance on that category. In total, your revised balance of debtors will come to 1,68,000. So notice one thing, under discount policy where you are giving better discounts, giving higher discounts, people are getting motivated to pay quickly. 80% of your customers are now settling your dues within 10 days. In spite of increase in sales, your overall average balance of debtors got reduced. Now, don't get carried away that this will be the base for cost of funds blocked. This is simply the average debtors balance. This is at sales value, whereas the cost of funds blocked will be dependent upon the funds blocked, and your funds blocked calculation is not based on sales value but based upon cost of goods sold. Let us move ahead and make another working, that will be working note number 3, calculation of cash discount. Under old policy, cash discount was 1% and the amount of sales that was eligible for 1% cash discount was 7,20,000. So amount of cash discount was 7,200, whereas under the new policy, first of all, your discount rate has increased to 2%, and the amount of sales that will be claiming that eligibility of cash discount is also substantially higher. That is 34,56,000 into 2%. That will give you 69,120. Now notice one thing. First of all, the rate of discount is increasing, and secondly, the portion of sales that is eligible for that cash discount is also substantially higher. Now don't wonder about from where did we get this information. We have obtained these calculations from working note number 1 and working note number 2. Now we have one more important working note to be carried out. That will be working note number 4, that is cost of funds blocked. Old policy, it was 2,60,000 amounting to your average balance of debtors, but I told you your cost of funds blocked is not based on sales value. So first of all, we have applied 80%. 80% of your sales will be cost of goods sold. So for having debtors balance of 2,60,000, your fund blockage is not 2,60,000. Your fund blockage is 80% of 2,60,000. So within brackets over here, that is 80% of 2,60,000 is basically the amount blocked, and 15% of that will give you cost of funds blocked. And then under new policy, your cost of funds blocked will get reduced because your average balance of debtors has reduced to 1,68,000, and 80% of that will be the funds blocked, and 15% of the funds blocked will be cost of funds blocked. Let me explain one very important point over here with respect to your average debtors balance. So many students may have confusions in their mind that why did sir calculate average balance of debtors. It's just another way of approaching the amount of funds blocked. Let me give you another example. Just another example. Assume that annual total sales, it is 24 lakhs. I'm giving you a complete different example, nothing connected to this particular case. Assume that annual total sales is 24 lakhs and you are giving credit period of 1 month, and your cost of goods sold is 80% of sales. So how will you compute the funds blocked? As per what you have learnt earlier, 24 lakhs is the amount of sales. Cost of goods sold is 80% of sales, so apply 80%. You will get 19,20,000. 19,20,000 is your annual cost of goods sold. Credit period given is 1 month, so 1 by 12 of this amount will give you the amount of funds blocked. So 1 by 12 of this amount, if I find, what I am getting is exactly 1,60,000 as my funds blocked. 1,60,000 is my funds blocked. This is one way of calculating, which you had been doing all the time. I am just giving you another perspective to this, another approach to this. So don't get confused over there. What is this other approach? You pick your total annual credit sales of 24 lakhs. Okay, 24 lakhs in this example is your annual total credit sales. On this, you first apply 1 month credit period, that is 1 by 12 of this amount will give you your average balance of debtors. That means in your balance sheet, your average balance of debtors, which will be written as sundry debtors, will be roughly 2 lakh rupees. That rupees 2 lakhs, which is standing as your average balance of debtors, if you want to understand one simple thing, my cost of goods sold ratio is 80%. That means what? If I am making sales of rupees 100, the money that is blocked from my pocket is not 100 but 80. When I am investing 80, I am able to create debtors of 100. In other words, if I want to create debtors of 100, investment from my pocket or funds blocked from my pocket is only 80. So on the calculator screen, do you know what is still getting displayed? Average balance of debtors 2 lakhs. I would now say, if I want to maintain average balance of debtors of 2 lakhs, money blocked from my pocket is not 2 lakhs, it is 80% of 2 lakhs. Can you compute 80% of 2 lakhs? It will be 1,60,000 as amount of funds blocked. Haven't we landed up at the same calculation? Now, if I don't tell you these alternative ways of making calculations, sometimes in questions ahead, what if a question directly tells you that average balance of debtors is so much? then you don't have any clue about what is your cost of goods sold. But if they give you cost of goods sold percentage or ratio, you can directly apply that ratio on average balance of debtors to find the amount of funds blocked. I'm sure you people are getting that clear insight that why did we have an alternate approach over here for making this particular calculation. So let us do one thing now. Let us see how to go ahead and make the comparative profitability statement. This comparative profitability statement will be again presented in two columns with old policy and new policy. And you begin with sales. Thereafter you subtract the cost of goods sold, and what you get is gross profit margin. And from gross profit margin, subtract two more components, that will be cost of funds blocked and cash discount, and what you get is the net amount of benefit or simply the net profit, and that profit is 6,81,600, and under the policy which is now proposed, it is 7,74,720. So we can see clearly that old policy has a lesser amount of net profit, new policy has greater amount of net profit. So new policy is definitely better than the old policy. We can go ahead with this. Now before you write up this comparative profitability statement, let me interrupt in between and tell you one more thing, otherwise you will have questions in your mind unnecessarily. Some time back I told you, mark sales as A, mark cost of goods sold as B, mark cost of funds blocked as C, and mark discount, that is cash discount, as D, and your net benefit will be A minus B minus C minus D. If I am presenting the comparative profitability statement that way or this way, it is just a presentation difference. There is absolutely no problem in adopting any approach. I am giving you different approaches just for a different kind of presentation, so that in exams you can even present a solution like this. And time for us to note down the conclusion. By changing the discount policy, that is by increasing the cash discount rate from 1% to 2%, the overall profit increases by rupees 93,120. Therefore, the new discount policy is worth implementing.